Gina, I want to start with you. We pointed out earlier, and we've got a list of high-flying tech stocks that benefited from the pandemic, and everybody's saying, well, those benefits are dissipating now, and this is what happens. And then but I read Apple continuing to benefit from pandemic-related effects. So Apple apparently still has a tailwind. Does everyone else have a headwind?
I think that's a good way to take it away, is that investors really are voting that performance matters over potential here. Apple's performance is delivering. I want to just underline why their performance is delivering. Is that iPhone was up 10% year over year. That is in part because of the pandemic tailwind. That's off of a 47% comp. Just remarkable that they still grew. But I think there's something bigger going on than just pandemic tailwind. I think that if you look at the amount of time that people hold on to their iPhones, it's basically been stable over the last couple of years at about 3.5 years. For a few years before that, it had been getting extended out. That was negative for iPhone growth. And I think this stabilization of the upgrades essentially points to iPhone becoming a necessity for those people. And that's what we're seeing in the results here. And I would just point out, too, is that iPhone is going to be the primary driver in the December quarter. And Apple doesn't, of course, give formal guidance these days. But if you read between the lines, they effectively maintain guidance, which puts them as the only big tech company that did that. So to answer your question, this is more than the pandemic. This is people just becoming further and further entrenched in Apple's products.
Gunjan, that's a big job. So I don't know. You're going to be very careful with all your words now, since they're very weighty. What do you think's happening?
So I think there's just a lot more differentiation among tech stocks, and that's what I'm hearing from investors. As you pointed out, this divergence in Apple and Amazon. What I'm hearing is the FANG stocks, for example. These stocks posted huge simultaneous gains for much of the past decade, and people almost approach them like one block, right? Like one trade. And you can't do that anymore. People are saying to me, look, we're getting choosier about which tech stocks we're holding because they have these rapidly changing fortunes. They're navigating this economy in very different ways. So you have to get choosier right now.
Do you think, Gunjan, that since tech always seems to, the potential of tech, the revenue growth numbers and the innovation, it always seems to leave the rest of the old economy in the dust. Yet, they're definitely more sensitive to what the Fed's doing or when interest rates are going up. So if you are looking at this market now and saying, these things are really a lot cheaper than they were, and if I want to invest for the long term, will they be the leaders again? Or is it, why fight the Fed? Why not go into dividend yield stocks that might do better? Maybe they do better in an inflationary environment.
Look, I think all you need to do is look at Caterpillar's performance yesterday in the market compared with Meta's. Caterpillar was up, 7-8%. Meta tanking more than 20% to see how investors are viewing that trade right now. I think a lot of people are looking at Meta and saying, look, it may be down 70%, but this is still not a good value to me right now. And it's because of rising bond yields, what the Fed is doing. Some of these companies are having trouble navigating this economy. They're dealing with a rising dollar. They're dealing with rising interest rates. Inflation is pinching their customers at the same time that investors have more choices to put their money, right? They can put their money in 2-year, 10-year treasury notes. They can put their money in I-bonds. So that changes the calculus, and it's going to lead to this continued divergence in markets that we're seeing ahead of the opening bell today, with the Dow futures outperforming NASDAQ futures.
Gene, have you been studying up on Rust Belt asset? I don't know. You're an expert on steel furnaces. On steel, are you going to switch?
I was going to make a big announcement today, Joe. Yeah, no more tech. I'm doing hard steel from going forward.
That's an idea.
I want to give just some perspective on your question too, if I may. Is that I think what we're seeing, this gravitation back to older type of companies. It comes back to that performance versus potential. That's the mood of the market, and that's obviously been dictated by a lot of factors over the last 6 months. But that eventually, I believe the pendulum will shift back, not just because I have spent my career in tech, but ultimately I think that these companies are going to grow faster than your traditional old line companies. And I know it's not Amazon lowers their guidance, stocks down, but let me just point out a specific on that, just to outline this idea about investors really want performance versus potential. Amazon effectively guided down by 5% for December, and the stock's down, call it 15%. And that to me is a disconnect. That to me is showing that there is just a mood switch away from these companies. But it's going to come back. Amazon's growth will stabilize. It will reaccelerate. No one can touch them when it comes to infrastructure. And I suspect that a year from now, 6 months from now, that it's going to be a much different picture from investors' perspective.